Hi, good morning, everyone. I'm Ken, and I'll be talking on the macro outlook today, and then we will have our future company SGX. So, disclaimers. Okay, so key events for the week is the Bank of Japan has outdone expectations by 50%, announcing a 7.5 trillion yen of asset purchase. This is 50% above our expectations, and they also want to achieve a 2% inflation target within 2 years. However, this bullish event was overshadowed by the bird flu in China. So how serious is the bird flu? Thus far, since February 13, 18 has been infected and 6 have died since February. However, there's been no known human-to-human contagion, whereas China authorities have covered up the incident in 2002. This time they are more open about it. On macro data and market outlook, the US non-farm payrolls added 88K jobs versus the 190K expected by the market. We have often warned that the first half of the GDP growth would be weaker than the second half due to payroll tax hikes. So we should expect a pause before reacceleration. And also it's not as bad if you take into account the better data in January and February. In January and February it was higher, and so if we were to adjust for previous higher performance, the difference would only be a 41K below expectations for the jobs data. And also, new orders for manufacturing and capital goods have been rebounding, and we are still positive on the US and believe that it will pick up in the second half of the year. Overall, for the year, we maintain that we are positive for the year, but short-term outlook-wise, it's dimmed a bit. No change to the cost for 2013, however. We are overweight on equities, underweight on gold, and market weight on bonds and commodity. However, the short-term outlook has been affected by the bird flu as the economists take a breather. Odds on is that it likely to lean towards going short rather than long for most indexes, as we would present shortly. Overall, the STI looks more resilient, which may be due to Singapore's safe haven status. So now moving on to the various charts, the S&P 500 is currently showing a short-term downside with a MACD bearish divergence, as you can see. It's going higher on higher highs on price and lower lows on momentum, as you can see over here. On the Nikkei, you can see a bit of a bearish in which there is it's sold into strength with a rejection candle over here. So once again, this was around the timing whereby the Bank of Japan announced the 7.5 trillion yen. On the HSCEI, the short-term downward suggested. As you can see over here on the right, there is a red candle which slammed into the 200-day moving average support level. It may consolidate from here, but the solid red candlestick on Friday suggests fresh selling momentum. Things are pretty uncertain over the bird flu. On the Hang Seng, short-term downside suggested too. Similarly, the red candle downward. And we expect it to have a downside to 200-day moving average. On the STI, once again, it seems very relatively resilient. However, the chart pattern, the global indices as we have presented are not as resilient, and we forecast a short should the 20-day moving average go below the 50-day moving average. Otherwise, upside prevails. On the SET, there is a bearish action, price action, and a bearish momentum. However, as you can see from our morning note, our Thai strategist does not expect it to go below 10%. On the JCI, short-term Downside suggested, once again, there is a bearish divergence on the MACD with higher highs on price and lower lows on momentum. So now we'll talk about our feature company for the day, and that will be the Singapore Exchange. So, and how our agenda for today will be the outlook for third quarter results, why we are positive on SGX, and our conclusion on why we have a rating of accumulate, and a target price of $8.16. So what's the outlook for the upcoming results on 16 April? Based on market data that has been released by SGX, the Securities daily average value is up 41.1% quarter on quarter to 1.71 billion. As you can see over here, the chart on the right shows quite a big jump from previous lower trading value in second quarter. And also positively, 60% of trades were of contract size below 1.5 million dollars, and this is actually a proxy in terms of the retail participation. So what this actually implies is that because of the lower average contract size, you're likely to possibly see higher clearing fees, because typically your clearing fees for smaller contracts are higher, and therefore the average yield would be increased, and therefore leading to an even higher revenue. And therefore we forecast higher securities revenue. On the daily derivatives daily average value is up 33.7% quarter on quarter, and to 0.479 million contracts. And this is actually a very big positive, given that in the previous quarter there was actually also quite a big jump. This is actually driven mainly by two future indexes, the China A50 and the Nikkei 225, both of which actually jumped more than 40% quarter on quarter, and actually contributed largely to the higher derivatives daily average value. And we forecast higher derivatives revenue based on the higher contracts. Also to note is that the average yield per contract, you can see from the red line, has been going down. We expect this actually to continue for next quarter. This is because the decrease is likely due to higher participation from the instis, and since the clearing for derivatives is on a tiered basis, for the fees tiered basis, the higher instis participation will actually lead to a lower yield, and also based on the different contracts also have different yields, and it seems as that the China A50 and the Nikkei 225 may be of lower yields too. However, the decrease in average yield is unlikely to be higher than the increase in derivatives contract, and therefore we still forecast an overall increase in derivatives revenue. So moving on other revenue, the higher trading activities is likely to lead to higher revenue because they are all linked. Like for example, we expect to see higher depository services. However, the IPO has been rather quiet this quarter, but bond insurance remains strong, and we also expect to see in general marginal quarter-on-quarter growth of other revenue for the quarter. On operating expenses, cost-to-income ratio is expected to increase quarter-on-quarter. This is because of a higher revenue base, with marginal quarter-on-quarter increase in expenses. So on why we are positive on SGX, SDAV, the outlook is that we expect SDAV to remain higher year on year. Although SDAV has slowed down since March 2013, we still expect it to remain relatively strong. This is driven by improving market confidence, in which we'll touch a bit more later. And also the DDAV improvement is rather concentrated, once again on the two index futures, but it's still expected to be strong. DDAV is expected to increase by a more gradual pace as compared to what we saw in the last quarter. And the derivatives revenue is now a stronger source of revenue. As you can see on the chart over here, the red bars represent the contribution by the derivative side, and since the 21% in third quarter that it contributed in 010, right now it actually contributes 28%, and this is expected to remain strong. So on improving market sentiments and confidence, the STI index is high, and trading activities are higher year on year. And we expect that the number of IPOs is expected to increase, since especially quite a bit of the IPOs has been put on hold last year. Right now, when market conditions has improved, we expect to see quite a few IPOs coming on board. And this will lead to an increase in listing revenue. Furthermore, it will also lead to higher trading interest and also an increase in trading activities. Also, we are also seeing a higher market participation from both the retail and institutional. In terms of number of distinct clients, there's actually been an increase in the recent quarter. And also, we are positive on SGX because of the strong GDP growth potential in the region, especially in ASEAN. So, other than that, there are also two strong sources of revenue. So previously, most of the revenue source was actually from securities revenue. However, right now, as I've shown previously, the derivatives revenue has been growing pretty strongly, and it's now quite a big additional revenue contributor. So right now, there are not only the higher contributions expected from securities, but also right now you have also another strong revenue from derivatives. So therefore, we see high upside potential. On the trailing 12 months, the price earnings ratio over here, as you can see, it seems pretty high. However, I'd like to guide that this is actually due to this is not we have not input in the higher expected earnings for the third quarter. And if let's say we were to look put in the prices for the forecasted earnings, you can see that your PE has a potential to go down to even 21, 22 times. And the reason for the current high PE is because in the trailing 12 months, the earnings has been relatively low. So with lower earnings, your PE would naturally increase. However, if should earnings go back up once again, as explained by the higher contribution from both securities and derivatives, then we would possibly see a lower PE, and therefore the share price, we think that at current levels is actually relatively cheap. Also, we are increasingly seeing more product offerings, both on especially on the derivative side, and the dividend yield is also attractive at around 3.6% right now, and there's actually quite a bit of room for growth because SGX has a very relatively big cash balance and also very stable cash flow. And in fact, we are actually forecasting that there could possibly even be a slight increase in dividends over the next 2 years. And we base our target price on a 2.26 times PE ratio, and based on current share price and also the better outlook for SGX, we have an accumulate rating on the stock. And with that, we'd like to welcome any questions from the floor. Thank you. So there's one question on what's SDAV and DDAV. Once again, SDAV would stand for Securities Daily Average Value. Security daily average value is the number of the value of the trades in the market. So for example, if let's say someone were to trade buy a lot of perhaps say SGX at 750, then the trade value would be 7,500, and then so we would add on all the trades in the market in Singapore through SGX, and that would give you the value for the day. And then the SDAV will be the average of the values for all this. On the DDAV, DDAV will stand for the derivatives daily average volume. So once again, when you put through a trade through the derivatives, the derivative would they will add up all the number of contracts in a day, and then they will divide it by the number of days and get the average value, average number of derivatives contracts traded. Hi, I have more questions on SGX. So one of the question is how significant is the joint listing of KL counters? I am not quite sure I catch it correctly, but I think you might be referring to the ASEAN links, in which right now they are, correct me if I'm wrong, that you're referring to the ASEAN trading links, and in which they're trying to link out quite a few of the exchange in ASEAN together. The contributions from this linkage, ASEAN link, is actually not that significant based on what we are hearing from the IR and the company. Um, right now, this is the amount of contributions from this ASEAN links, trading links, actually relatively insignificant, and they do not expect this to be a driving force of increase in securities or derivatives trading activity. This is actually more to increase the exposure and the interest in our markets, but through the link, the trading once again is relatively low. And also on the average dividend for SGX payout, the average dividend as you can see over here, the dividend per sorry, the dividend per share is 27 cents currently, and this would give a yield of 3.6%, and the dividend payout ratio is I sorry, I can't remember the give me a moment. So as you can see from our reports, the dividend payout ratio is approximately 90+%.
Hi, this is Wei here. I'll take Danny's questions about whether we expect HSI to fall further. Our house view is that the Hang Seng Index we expect the Hang Seng Index to actually see near-term weakness. From a technical point of view, at this juncture, the Hang Seng Index is hugging its lower Bollinger Band, and we also see a bearish moving average crossover. So this suggests near-term weakness for the Hang Seng Index. And it seems that the Hang Seng Index also takes the cue from the Chinese market, the Asian HM market, which has been weak thus far. And we all know that the Chinese market has been weak because of recent property curbs, as well as curbs on the wealth management products front. So in short, yes, we expect the Hang Seng Index to fall further.
Okay, I have one question on today's morning note on what it actually means to be on judicial management. So what happens is that when a company is under judicial management, it means that the creditors are not able to demand back their loans made to the company, and this actually protects the company and allows it some the ability for it to restructure, so that it would be better able to pay off its creditors in the future. Because should all the creditors go after the company for its cash, then it would not have the working capital, etc., to be able to try to recover, and that is why the company is under judicial management.
Hi, morning. This is Brian speaking. Today we have another question on Court Life Group Limited, which we initiated this morning. I can briefly talk through the company right here. We are positive on the company on a few ground. Firstly, it is the company free cash flow, which we think it's remains strong, and it will continue to be strong because we see the capex for the company to remain stable, while revenue is coming in when the so-called customer continue to pay their premium to subscribe to Court Life services. And secondly is we see potential for asset acquisition by Court Life for other business in Indonesia, India, and Philippines from their parents, Court Life Limited in Australia. And thirdly is we expect their core earnings to continue to grow for the next few years. So the last point also is on its valuation. Currently, we estimate the earnings. The PE, forward PE, is only 15 times, which relatively low currently. So for further detail, I think we would like to advise you to read into the report that we issue out this morning. And if you have further question, maybe you could email direct to research email or email to the analyst Derek. But today he's not here today, so he won't be able to answer your question directly this morning. Thank you.
Yeah, hi. This is Wei here. I'll answer Daryl's question about the Europe and US market. Now, okay. So in the near term, right, as Daryl correctly pointed out, the US market might rebound because as at last Friday's close, we actually saw a bullish pin bar. So US market might see actually another leg up. In terms of a medium term and longer term point of view, even though the Europe market weren't doing well last week on the whole, but there are actually pockets of strength. So if you look at the German index, which is the DAX, it's actually been performing quite decently well year to date. So for the Europe market itself, we might want to look at pockets of strength in specific economic, rather specific region index, like the German DAX and stuff like that. Yeah. Alright, for Eric's question about the STI, I think this week we might see a couple of risk events. First of which would be actually Thursday morning 2 a.m. Singapore time, where the March FOMC minutes will be released. So we expect markets to actually remain undecided till then, barring of course an escalation of bird flu risk, etc., etc. So in short, yes, there could be a temporary pullback in the STI already. And this morning I started to slip lower, and yeah. So the major risk event will actually be the FOMC minutes this Thursday morning Singapore time, as well as MAS semi-annual monitoring meeting this Friday, right? And that should be the major risk events for the STI this week. Alright, with regards to actually Daryl's question again, how we actually see the US and Europe market overall performance for this month. So this month is April, and historically, on average, April tends to be a good month for equities, after which there's this sell in May kind of syndrome. But specifically on the US market, what we're actually seeing is that although jobs data actually disappointed last week, the rest of these economic sectors such as the housing, the capex is still humming along nicely, right? And that should continue to lend support for the S&P 500 and the Dow, which is lingering now at fresh highs. For the Europe market, like what we mentioned earlier on, Europe market on the whole is weak, right? The stock 600 index is weak, but there are pockets of strength within the EU bloc. These pockets of strength could be seen in the German DAX, DAX index, and thus if those that want to actually, look in the Europe market, you might look at specific country indices rather than the whole Europe indices per se. So in short, April could be still a decent month for equities on the whole, before possible uncertainties coming in May, which includes the need to raise the debt ceiling in the US come 19 May. Thanks. With regards to Ming Quek's question about whether the STI is on the path of correction because it's closer to May now, well, at this juncture it's rather blur, but as we all know, when they start to rally quite a fair bit, it's inevitable that they will pull back off and on. So I wouldn't say we are on the path of steep correction per se, but we might pull back, right? Waiting for further confirmation of the outcome of the FOMC minutes this week, as well as other risk events unfolding. But on the whole, we remain positive on the STI, right? Because from a charts basis, the STI still looks the most resilient among the ASEAN economies as well as the developed economies of US and Europe. So on a relative basis, even though STI is experiencing a minor pullback, but we are still positive on it. Thanks.
All right. Before we end today's presentation, we would like to bring your attention to one of our upcoming company presentation. It will be on 17 April by Rigmers Maritime. Time will be 12:30 p.m. to 2 p.m. At our head office, presentation room, level 6 at Raffles City Tower. And if you are interested to attend, you could register at this address here at rigmersmaritime.eventbrite.sg, and seats are limited, so please register early. And the company, the management of the company will be here to share with you about the development in the company. Lunch and drink will be provided. So right now we would like to thank you for joining us today, this morning, and we will hope to see you again next week, next Monday. Thank you very much.